And we're only talking about appreciation. We're not talking about the fact that you get into a mortgage payment and it's fixed for 30 years. It never goes up. Well, guess what? Rent goes up every single year. Every time you renew that lease, it goes up. You have tax benefits on owning. You don't have tax benefits on renting. Like, it is insane. Welcome to Loans Elevated, the podcast that brings you the latest industry news, expert interviews, and insightful discussions that will help you stay ahead in this dynamic market. I'm your host, Broch Lassig, and I've spent years in the trenches of the mortgage industry, helping individuals and businesses navigate the complex landscape of real estate financing.
I'm your co-host, TJ Heidenreich, and together we'll cover a wide range of topics, from business strategies that skyrocket your success to mindset and motivation that fuel your growth.
All right, so talking about timing the real estate market and why you might be doing it wrong. So we hear constantly that people are waiting for something in particular. I'm waiting for home prices to come down. I'm waiting for rates to come down. I'm waiting for the election. I'm waiting for something or the other. And people are always waiting, and that's just basically saying, hey, I'm timing the market to what I think would be the most optimal. And we have a strong opinion about that, why that doesn't seem to make a whole lot of sense. So with that, I think I would just start by saying, we've said it many times before, but it's very unlikely that you can purposefully time the real estate market, or any market for that matter, but in this case, the real estate market, properly. It is a matter of being in the market for a long period of time, not timing exactly the right time to enter the market. And that's
the difference between a trader and an investor, I would say.
Yeah.
An investor consistently buys into a market, and they know that in the long term they're going to get a positive, I guess, return on their money. A trader, you might have to be a little bit more selective on when you're buying, you're getting into investments and selling, because that's how you're making your money. Most people aren't traders.
Most people aren't traders. And the other thing is
investors.
Exactly. And the other thing is that might be like a flipper in real estate.
Exactly.
But now what are they doing? They're literally creating taxable income on every single transaction. Like, that is defeating at least half of the value of real estate.
Yeah.
Is creating a taxable event over and over. And like you said, most people, it's not what they're doing. They're going to buy this house. They're going to live there for 5-10 years for the most, or at least own it for 5 to 10 years or longer for the most part. Rarely do you talk to somebody that's like, I'm going to buy this, I'm going to sell in a couple of years. Almost never.
Well, even there's a lot of investors, and this is probably the select few high-income earners who will just buy real estate, doesn't matter what's going on in the market, for tax advantages, and knowing that they're going to hold on to it for 10, 15 years, 1031, and continue to defer their tax bill because they know it's going to return. I mean, there's not a single market out there that has the track record that real estate does.
Yeah, well, and to that point, like you just mentioned, there are lots of people that'll buy real estate. So whether you're a first-time home buyer, you're talking about investors, wealthier clients, like, there are strategies from like a accelerated depreciation. It's called cost segregation, where you can depreciate literally hundreds of thousands of dollars against your other income. So against your regular employment income, by buying an investment property and accelerating the depreciation and reduce your tax bill. I mean, by doing that, let's say you do it and you get $200,000 in depreciation write-off. That can offset not just the rental income on the property you're depreciating, but also your regular W-2 or self-employed income. So it's like
instead of going to Uncle Sam, now you get to
discount.
keep. Oh yeah,
it's insane.
It's the quickest raise you could give yourself.
Yeah, 100%, which is crazy. And if you look at it, all right, and you and I have talked a lot about this as far as timing. When do we put the cash that we have in the market? Yeah. Same thing applies to real estate. It's like it's unreasonable to time any market. But like, you look at real estate. Let's say you're, quote unquote, timing the market and you've been waiting for rates to come down. Depending on where you're looking and depending on the specifics, I'll talk in broad stroke estimates here. If you've been waiting for rates to come down, you've been waiting for, let's just say, at least 2 years. And over that 2-year period, even though it's been a depressed market and there's been fewer transactions happening, and housing is more expensive because rates are high, so on and so forth. Even despite all of that, you've been waiting for rates to come down, and you have literally lost, I would say minimum 8%, maybe more like 10 to 12% in appreciation, even in a depressed market. So you think about it. 2 years ago, when that house was $500,000, you've been waiting on rates to fall for 2 years. That $500,000 property, let's just choose the low end. It's increased 8% over that 2 years. So in other words, you've lost $40,000 in 2 years by waiting. We'll take 40 grand, divide by 24 months. That's $1,700 a month that you've lost in wealth creation. I promise you, on a $500,000 property, the rates even being where they are now, even being at the peak where they were, it's not costing you an extra $1,700 a month on a $500K house. And then it's all relative, right? So if you spent more money, you're going to lose out on more equity, and the payment, obviously, the delta is going to be different. But like, timing this is it's a loser's game. It's a fallacy.
Yeah. Well, and I think people have it a little backwards because the people, like the big headline trades and the person who bought the one cryptocurrency that blew up and made them millions, and just weird things like that, anomalies, they really think it's just like one person who got lucky, they bought it at the right time, and then that's how they amassed their wealth. And it's really not the case.
Yeah.
It's consistently investing, and then you get the benefits of certain pops like COVID for the real estate market.
Yep.
Most investors that made a ton of money, they owned tons of real estate leading up to COVID.
Exactly.
They didn't buy in COVID and panic bought a bunch of real estate. They had the real estate leading up to it, and they continue to buy more. They got the benefits of all the
They had been a real estate investor or a crypto investor or a stock market investor or a name a market investor for a long period of time, and they just happened to be an investor during the time that it popped. And guess what? When they bought before it popped, I promise you, 99.9% of those people didn't think it was going to pop. That's not why they bought.
Yeah, they just knew it was a good investment. They didn't think it was going to yield 50% in 2 years.
Exactly. It's crazy.
It's like to refer to, sports, for example, Kobe Bryant. Most missed shots, I think, out of any other professional basketball player.
Yeah.
But one of the greats because he continued to shoot the ball. It's just like investing.
Yeah. 100%.
You're exposing yourself to higher chances of getting those pop-off crazy investments where you get crazy yields that are anomalies if you're continuing to invest.
So now to reel this into real estate.
You're not going to do it just by the one purchase at a lucky time.
Right. You're not going to do it at a lucky time.
No.
But in real estate, you can do it with one single purchase. Because if you own that home for an extended period of time, at some point over that period, there's likely to be that pop in equities. So it doesn't matter if you bought it at the quote-unquote peak, there's going to be another peak. Or you buy it today, for example. So like I read a stat, and I was talking to a client about this week. We often get in our industry estimates on what is the 1 year appreciation and then what is the 5 year appreciation. And the estimate that I saw, this is not precise because there were some decimals here, but the estimates that I saw was the 1 year appreciation is approximately 3% estimate is what they're expecting the next 12-month appreciation rate to be. And I think that was actually the next 2 years was 3% per year.
Yeah.
But the 5 year was 27%. So if you think, that means that within that 5 year period,
at some point you're going to have a little bit of a pop.
You're going to have a pop because if you're only getting 3% for 2 years, that takes 6% of that 27. Yeah. So then in the final 3 years, you're getting a compounding 7% annualized. Like at some point that pop is going to hit, and there's no way you can foresee it because, at least in our opinion, the way it's going to happen is something unexpected is going to hit the economy. The economy is going to suddenly be in a recession, and the Fed's going to take some extreme action, and mortgage rates are going to fall unexpectedly, and the thousands and thousands and thousands of people sitting on the sidelines waiting are going to flood into the market and buy a bunch of property, and bam, you have a pop. And you were talking about crypto. I think about, I've been talking to a lot of my clients about this because obviously crypto's now hit recently new all-time highs. So who's talking about it? Everyone. I was getting my haircut, sitting like they were washing my hair, and I could just overhear the conversation next door to the other bay. The hairstylist talking about cryptocurrency.
That's funny. I heard the same thing
at the
last time I was getting my haircut too.
It's ridiculous. Yeah. So like you're hearing it.
It's literally herd mentality is what we call
100%. But guess what? in 2021 and 2022 when it was literally probably the
golden
best
years
time to buy crypto in the last 7 or 8 years was 20 and 20, 21, 22. No one wanted to touch it. People wouldn't speak about it because the people that had a bunch of crypto were embarrassed because their crypto had fallen to a crazy low range. And everyone else that wasn't in crypto was like, oh, this is a crappy investment. It's dropped like, 70%. They didn't want to talk about it. So what does that show? We've talked a lot about this, which is be fearful when others are greedy and greedy when others are fearful. Well, right now in 2024 and over the past couple of years, no one's interested in real estate. It's not the cool thing to talk about. No one wants to buy it. Rates suck. Family parties, people are like, oh yeah, real estate. It's not the conversation.
It's unaffordable.
But when was it the conversation?
Future, during COVID.
Exactly.
Historically
and what
low
happened
interest
during
rates
COVID?
Blew up.
We saw 25% appreciation.
Year over year. Yeah.
Like, that is not the time to buy. The time to buy is not when it is absolutely skyrocketing. The time to buy is now when it's quiet and no one is worried about it. Because then you get in and you capitalize on that skyrocket appreciation when it comes. And we don't know when it will come.
Well, I think people tend to forget about real estate and the uniqueness, not only of it, the fact that it's leveraged, and so you're appreciating off of, sometimes 97% of other people's money.
Right.
But also it's...
Or 100%.
Or 100%.
If you do down payment assistance.
Yeah, or 100%. But you can also utilize it. Like, the only other comparison of an investment that is also can be utilized in, like, living in it and having it be tangible is gold. But
you compare gold.
Compare gold. Yeah, exactly. I'm saying, but compare gold to real estate. It's not comparable.
Not even the same thing. Yeah.
So whether it's investment driven or not, you also have to think about you're benefiting from multiple ways when you buy a house. You're going to get the investments, but you're also going to be able to live in it. There's all sorts of things you can do.
You can tap into the equity over time to leverage other investments, to protect yourself against unforeseen circumstances. Say there's a job loss or a sickness, you can lean on the equity in the house to fund that without selling it. You don't ever lose the asset. So you keep making money even though you can leverage it and use it to your advantage, which is crazy.
Which, sure, you could do that with stocks, crypto, whatever, but
it's way more risky.
Near exactly, because the volatility is way higher.
Yeah, you can get calls because your loan to value drops and it's just way more at risk. Now, I did take a screenshot. This is something we've presented on a bunch of times. So I'll just name some of these things and the dates. So this was, let me just expand this real quick. All right, so these are some media headlines. October 6, 2015. Housing Today, a bubble larger than 2006. In November 16th, 2017, homeownership doesn't build wealth, study finds. September 5th, 2018, it's better to rent than to buy in today's housing market. July 9th, 2019, the housing market is about to shift in a bad way for buyers. July 9th, 2019. Now, July 26th, 2021, the housing boom is over as new home sales fall to pandemic low. So there is all of the, similar to what we're hearing now, all the media headlines over the years tend to be negative naysaying about real estate. But guess what? During those times, if you would have bought 2015, 2016, 2017, 2018, 2019, 2020, you would have literally made hundreds of thousands of dollars, and that hundreds of thousands of dollars, if reinvested properly over time, which is something we are experts at, that's what we pride ourselves in guiding our clients in at least understanding and making the right decisions, could literally turn into a multi-million-dollar retirement plan just because you bought a property and held onto it for a few years and were strategic in the way you handled it and didn't buy into all the BS from big media just clickbaiting you and or family and friends that are well-meaning probably in most cases, but they are not experienced enough to be guiding you on when the right time to buy real estate is. It's just the way you are losing money every second that you listen to these types of people.
Yeah, I think we're such a population where we're so focused on the short term, right? Like the micro stats.
And
what we
affirmation.
hyper-focus on. Yeah, and the emotional side, of course, very emotional. If you're going to analyze whatever you're investing in, look at the actual macro stats. Look at the last 40 plus years or since inception and look at what the actual data is. Don't look at what happened last month where rents were slightly lower than mortgage payments and decide to make your decision on your future because of the 1 month.
Right.
And that's probably when those articles came out. There was probably some sort of negative sentiment about housing that was following that quarter of data, which is what these media companies rely upon.
Yep.
The short-term, quick clickbaity information. If they actually showed a graph of housing since we've tracked it and the return that it's given, they would look stupid.
And we're only talking about appreciation. We're not
Right.
talking about the fact that you get into a mortgage payment and it's fixed for 30 years. It never goes up. Well, guess what? Rent goes up every single year. Every time you
Again,
renew
it's
that
multifaceted.
lease, it goes up. You have tax benefits on owning. You don't have tax benefits on renting. Like, it is insane. And, you know, I guess we'll just close this up real quick. I've got a comment that we can kind of stitch in here, which is there are legitimate concerns and reasons people don't want to buy today. And frankly, we have rarely, I'll say, but we are not attached to you buying a house today. I can tell you that right now. Whether you buy today or you don't buy today, we want to do what's right for you in your situation. So sometimes we will guide a client to be like, hey, maybe it is time to pause. And you shouldn't do this. And you should wait for X, Y, and Z. For the most part, that's not the case. 9 times out of 10, I would say, people should buy. And they're making emotional decisions on why they shouldn't buy. For example, high rates. That's the big thing right now. High mortgage rates, it's unaffordable, payments are too high, so on and so forth. You may not believe us, but call us. We can coach you through it. We can literally get mortgage rates 2 and 3% lower than the average mortgage rates you see online. We can get rates 2 and 3% lower than that right now. And you can buy at a time when no one's talking about it. It's the time when everyone's fearful. It's when you should get greedy because you'll have the opportunity to create massive wealth. And we have strategies around it. That's the cool thing about our industry. It's a very dynamic, creative, resilient industry that comes up with solutions to the problems that we face because we're always facing a problem. So I would say don't let all of this crap hold you back. Lean on experts. Lean on us. Don't lean on the media. Don't lean on family and friends, even though they're probably well-meaning. They, frankly, are not experts. We do hundreds of transactions a year. They may have done 1 or 3 or 5 in their life. We do that number of transactions every single week. So I would just say lean on us. We would love to go guide you through this, share additional details. Another thing that I wrote here, we said tax benefits, but we've got Become Your Own Bank. That's a strategy we leverage a ton to help people realize the possibilities of owning a home. And then also we have cost-free refinances in the future. So when rates come down, you're not worried about a hurdle of massive cost to refi and get your lower payment. We cover that. We've already solved that problem for you in addition to today's rates. So that's my closing statement. I don't know if you have any other thoughts or ideas, something that's important that I've missed.
I think the only other thing that I would say is it's an emotional decision. We get it. We're home buyers. We've been home buyers. And it can be very emotional. We get it. What's the easiest way to calm emotions? You talk to experts. You look at data. We have all of that. We are the experts. Talk to someone who knows what they're talking about, can give you the strategies to help calm those emotions. You're going to make the right decision in the end. And you're going to look back and think, oh, gosh, I was being a little dramatic. I know we have conversations all the time between you and I. Certain investment decisions. You'll get emotional, I get emotional. Then we start looking at the data, and it's like, we're just being silly. So
you need that neutral center mediator, basically, which can be us, to help temper the emotions, assess the real legitimate
just facts, no emotions,
concerns you have, but we stitch it all together because there are legitimate emotional concerns that people have in housing. But then we know the facts and we take just a neutral approach to stitch it all together and make a good solution. 99 times out of 100, we have a solution that meets every client's need and desire plus some. And they just aren't thinking through holistically through the process. And that's what we're good at. So, cool. Well, thanks for tuning in, guys. We'll catch you next time.
Thank you for tuning in. For more industry insights, follow us on all platforms at Loans Elevated.
And to get in touch with our team, call or text 801-713-4000 or visit loanselevated.com.